In a stunning turn of events that sent shockwaves through the financial world, Wells Fargo, once considered a stalwart in the banking industry, now finds itself on the brink of collapse. They're dealing with a bunch of scandals and bad behavior that are ruining their once great reputation. Some employees got caught making fake accounts to meet sales goals, and now people don't trust the bank anymore. It's like a warning about companies being too greedy and the people who are supposed to make sure things are fair, not doing their job. Wells Fargo, once the largest mortgage lender in America, is accused of discrimination through the common industry practice of offering mortgage loan discounts to selected borrowers. In 2012, it paid more than $184 million to settle federal claims that it charged minorities higher fees and unjustly put them into subprime loans. It was fined $250 million in 2021 for failing to address problems in its mortgage business, and more recently paid $3.7 billion for consumer abuses on products including home loans. After receiving an MRA from the CFPB, it hired a law firm to look into mortgage bankers' such practices, whose sales included high levels of discounts. The CFPB's probe into mortgage lenders was shared back in fall 2021. Its findings showed that mortgage lenders violated the United States fair lending laws by discriminating against African American and female borrowers in the granting of pricing exceptions based upon competitive offers from other institutions. Since then, regulators conducted additional examinations and again found that mortgage lenders violated Equal Credit Opportunity Act and Regulation B by discriminating in the incidence of granting pricing exceptions across a range of ECOA-protected characteristics, including race or age. Wells Fargo was repeatedly slapped with hefty fines regarding its missteps involving home loans recently. Lesser-known legal problems have been stalking Wells Fargo since 2008, when it was among the major United States banks to be criticized with a nationwide class action lawsuit for allegedly deceptive overdraft policies. For years, Wells Fargo and other banks reordered customer transactions from highest to lowest payments to maximize the overdraft fees they could collect. Wells Fargo was hardly alone in this overdraft money-making scheme, but it's the only bank that refused to settle or ask for arbitration when it was offered. Instead, after waiving its right to arbitration, the bank chose to litigate, and when that didn't work, it forced its customers into arbitration. A related class action lawsuit in California involving overdraft fees was settled in 2016, with Wells Fargo ordered to repay $203 million to customers. A federal judge reaffirmed his ruling that the bank had misled customers to think the transactions were paid chronologically when they were actually paid in a high to low order, solely to yield more overdraft fees. In a letter to Wells Fargo CEO Timothy Sloan, members of the banking committee expressed concern with news reports that the bank's income from overdraft charges grew by 7.5% between July and September 2016. The committee noted the increase was 5 times faster than the rate of Wells Fargo's main United States competitors, including JP Morgan Chase, Bank of America, TD Bank, and US Bank, which had an average increase of 1.3% during the same period. Predatory lending. Predatory lending refers to the use of fraudulent, deceptive, or other unfair tactics designed to trick low-income borrowers into taking out mortgages they cannot afford. For instance, in Oakland, California, the city accused Wells Fargo of damaging the city's property taxes by engaging in racist loan practices. The lawsuit claims that Wells Fargo did 2 things against the law. First, they practiced redlining, which means denying home loans to minority residents. Second, they engaged in reverse redlining, where they provided expensive and unfair loans to minority borrowers compared to similar loans offered to white borrowers. Oakland argues that Wells Fargo often refused to refinance costly loans made to Black and Latino residents, leading to more foreclosures in those communities. The court agreed that Wells Fargo's actions likely caused the city's reduced tax base, but dismissed claims for damages related to increased municipal expenses, stating it was challenging to pinpoint how much Wells Fargo's actions directly contributed to those costs. Fraudulent practices. In September 2016, Wells Fargo paid $185 million to the government for fraudulently opening more than 1.5 million accounts without customers' knowledge. The former CEO of Wells Fargo, John Stumpf, was called to testify in front of Congress to defend his and his company's conduct. This conduct included opening 1,534,280 unauthorized deposit accounts, submitting 565,443 unauthorized credit card applications, opening unauthorized lines of credits, and various other fraudulent actions, all without the customer's knowledge. Again in 2020, Wells Fargo agreed to pay $3 billion to settle investigations by the Justice Department and the Securities and Exchange Commission related to its another fake account scandal. The bank admitted to wrongdoing and a failure of leadership in prioritizing short-term profits over its reputation and customer well-being. The settlement includes a $500 million civil penalty to be distributed to investors by the SEC. Although the payment is significant, it represents a fraction of Wells Fargo's reported net profit of $19.5 billion in 2019. The bank has been under regulatory scrutiny since 2016 for creating millions of fake accounts to meet sales quotas, leading to penalties and changes in leadership. Harming black homeowners. While the record-breaking nature of the fines levied against Wells Fargo drew headlines, many of us are left wondering if even those billions of dollars and the threat harsher restrictions on its ability to do business and will be enough to rein in the awful practices that have plagued the bank for over the last decade and led to financial hardships for thousands of consumers. What is even more infuriating about Wells Fargo's actions is that this is not the case of the wealthy and powerful ripping one another off, but instead one of the country's largest banking institutions taking advantage of hard-working Americans, many of whom come from minority communities and have dealt with decades of institutional racism and mistreatment. According to a federal investigation, the bank from 2004 to 2009 harmed Black and Hispanic communities through engaging in discriminatory lending practices against 30,000 Black and Hispanic borrowers. And a recent report found that the nation's third largest bank by assets rejected more than half of the home refinance applications sent in by Black homeowners, while approving almost 3/4 of those sent in by white applicants. There have been calls in the past for Wells Fargo to atone for its sins against the Black community. Most notably, last year, Corporate Accountability called on the bank to pay reparations after it acquired a number of former banks that were founded by or benefited from slavery. The nonprofit also criticized the bank for bankrolling two of the country's largest private prison conglomerates. In order for justice to be truly served, this financial institution must be required to make meaningful reparations to the Black communities that were disproportionately affected by the financial crisis it created. Hundreds of branches are closing. Unlike its rivals, Wells Fargo can't outrun low rates by either lending more or spending less. That's because it is still operating under an unprecedented asset cap imposed by the Fed 5 years ago. Those sanctions limit the bank's ability to lend and require it to spend more to resolve its compliance problems. They reported average loans of $900 billion, down 6% from a year earlier. That includes a sharp 15% decline in loans to businesses. After setting aside $14 billion to cushion against bad loans during the first 3 quarters, Wells Fargo is no longer stockpiling cash. The bank is also under pressure from Wall Street to cut costs and aims to cut another $1.5 billion of expenses in 2021, which will include laying off workers. Over the next 3 to 4 years, Wells Fargo said it hopes to eliminate $8 billion of expenses in various ways. The bank closed 329 branches last year and is planning to shut many more in 2024. Like other major companies, this bank is also rethinking its office space. The bank plans to cut its 46 million square feet of office real estate by 15% to 20% by the end of 2024. Too much volatility, weak quality and growth. Diving deeper into Wells Fargo's finances tells that there are some issues with this massive bank. In the fourth quarter, the bank experienced a significant decline in revenue, dropping by 5.8% to $19.6 billion compared to the same period the previous year. Operations reported a loss of $3.3 billion, leading to a 51.4% decrease in diluted earnings per share year over year. While the bank fares well in terms of value with a score of 80, its growth factor is notably low at 30. Quality indicators are in the red 33, with a return on assets at 0.6%, falling below the banking industry average of 1.1%. Returns on equity and investments also lag behind industry standards. Wells Fargo's stock performance signals a lack of momentum, posting a 22% decline over the past 12 months. These factors collectively suggest that Wells Fargo's stock may be characterized as a value trap, indicating potential risks and challenges for investors. The role of banks and government in Wells Fargo collapse. The collapse of Wells Fargo in the early 21st century is a complex financial debacle that involved a combination of unethical practices within the bank and regulatory oversight by the government. One of the key roles played by Wells Fargo was the aggressive pursuit of profit through the implementation of a high-pressure sales culture. The bank incentivized employees to open unauthorized accounts for customers, leading to a massive scandal that eroded trust in the institution. Additionally, Wells Fargo's lax internal controls and inadequate risk management allowed these unethical practices to persist and escalate over time, ultimately contributing to the downfall of the bank. Strategic recommendations. In 2024, Wells Fargo needs the company's growth strategy to win the competition in the industry and to keep their position in the market stronger. Wells Fargo can use an incentive strategy by doing market penetration and integrated strategy by doing horizontal integration. The action plan we suggest they follow is to develop a competitor's acquisition program. They can acquire Wachovia and start negotiation and an agreement, as well as preparing the takeover funds. They should also develop a marketing and publicity program by setting up the organization and resources, set up the 10-year business plan, and start the promotion of the business. They should open international offices abroad, develop insurance business entry programs, and marketing and publicity programs. Comment down below on what you think, and leave a comment if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.